You're watching Behind the Headlines. I'm Pacchia. This week we are watching yet another bailout in the EU, this time with the tiny island nation of Cyprus needing tens of billions of dollars to prop up its banking system. The particularly controversial part of this episode is that EU regulators proposed using funds from depositors at Cypriot banks to help bail out the troubled institutions. This is a profound departure from previous bailouts, something that happens very rarely, if at all. Joining me now to walk through it, I'm happy to say we have Lee Buchheit, partner at Cleary Gottlieb. Lee, of course, is known as the world's leading advisor on sovereign debt matters, having worked on many restructurings all around the world. Welcome back.
Thank you, Lee.
Lee, this looks like a fiasco from where I sit with my Bloomberg terminal. Is it that, or is there something more elegant at play here?
I don't think there's anything elegant about what's been done. They, as you know, initially decided that they would finance a portion of the bailout money by taxing depositors, both insured depositors and uninsured depositors in Cypriot banks. That met with a storm of protest, did not garner a single vote in the Cypriot parliament, so they backed off that. And what they eventually came to was an arrangement in which they would effectively liquidate the second largest bank, move good assets and insured deposits to the largest bank, and then even for that bank, recapitalize it not with external funds, not with official sector funds. They would recapitalize it by taking the uninsured deposits in that bank, and they will convert some portion of them, said to be 40%, into equity. And that's how they'll achieve the capital ratio.
A little Eurozone banking 101 here. Who was supposed to insure these deposits?
Well, the local deposit insurance framework. And therein, I think, was the problem, because people had been everywhere, even in this country. People view that FDIC decal on the teller window is conveying a sense that the government is protecting you at least up to the minimum insured amount. When you wake up one morning and find that the government is itself casting a covetous eye upon your deposit and wanting to tax it, it looks like a breach of the understanding that had been behind deposit insurance scheme.
It spooks people. And even now where we're focusing just on uninsured deposits over 100,000 euros, it's still very difficult to unspook people,
Yes.
So to say. Why were regulators caught so much off guard here? The handling of this makes other bailouts almost look elegant.
I know. I was joking with some of my Greek friends to say the one good thing that came out of this, it made the Greek workout look disciplined and farsighted. I think it was, they were tone deaf on this question of taxing the insured deposits. That was just a blunder, and I think they quickly came to realize it was a blunder. The basic philosophy behind this, however, is that instead of injecting official sector money to recapitalize weak banking systems in the periphery, what they'll do is use the uninsured deposits to achieve that recapitalization. It comes a little late for our Irish friends. In November of...
Who have to be furious.
Oh, they must be. In November of 2010, the Irish banking system also collapsed, but they were told very sternly that they had to take on the shoulders of their taxpayers the liabilities of that system. They wanted, I think, to restructure them and in effect impose some of the losses on the senior bondholders. But they were told, largely by the European Central Bank, that to inflict a loss, any loss, on any senior bank creditor in the Eurozone would cause such an erosion of confidence in the other banks that it would raise their borrowing costs and perhaps put some of them out of business. So this was a complete reversal of field on that issue.
Yeah, gotta wonder why we have this reversal. If we need to look to depositors to make up the losses here, that necessarily means that investors can't? Does that mean that the situation is so bad that equity and bondholders have just simply been wiped out?
Yes, well, in this case, the equity and the subordinated debt will indeed be wiped out.
Where did Cypriot banks lose so much money in the first place? Are we talking about bad loans to bad people here, or did they lose money on sovereign debt?
Well, a little bit of both, maybe a lot of both. They there was a real estate boom in Cyprus, fueled by an awful lot of the money coming into the system, not unlike Ireland or Spain for that matter. But also, they had invested very heavily in Greek government bonds. And when Greece did its restructuring last March and imposed a 53.5% nominal haircut on all of those Greek government bonds, that hit the Cypriot banking system very hard.
Now, were these business decisions that Cypriot banks made, or was this done at the behest of the ECB? Wasn't that part of what Basel II was about?
Well, no, it wasn't done at anyone's behest. It was a business decision that they made. They were allowed under the European bank regulation rules to book a Greek government bond, indeed any Eurozone sovereign bond, put it on their balance sheet without any capital charge at all, as though it had no risk.
And they're chasing yields.
Yeah, they're absolutely chasing yields, but it turned out to have a huge risk.
Sure. So what's the end game here? We declare banks insolvent, someone pays out the insured deposits. Is there enough money in the kitty?
Well, there will be. I think they can achieve a capital ratio. The difficulty that Cyprus has now is that all of the financial predicates that went into figuring out how much money would be needed to recapitalize these banks all assumed that there would be a contraction in the economy, but nothing like what they're going to have now. So the situation, it's kind of spiraling down. They will need more money because the economy's worse. Tax collections less, deposits will flow out when they can flow out. Right now they're subject to temporary capital controls, if that's not an oxymoron. But when those capital controls are lifted, one assumes that that money will flee the island.
Mm-hmm. So then what happens?
Perhaps another round of restructuring. I'm not sure this one is over, Lee.
Do you think the ECB has a clear picture as to how much they're going to be on the hook for?
No, I don't think so.
No clue? What's the best guess?
I'm not sure there is a best guess at this point. The liquidity that will flow out when it can flow out will have to be replaced by the ECB through something called the Emergency Lending Assistance Program, the ELA program. So ultimately, they'll be displacing the money that's leaving. How quickly it will leave will in part depend on how quickly they lift those capital controls.
So out of the Cyprus episode, we see this deliberate move by regulators to move or place the burdens of these bailouts on investors and depositors rather than taxpayers. Is this the new template going forward? Did Cyprus set the template for subsequent sovereign restructurings in the EU?
They have certainly changed the rules of the game. As I said, until Cyprus, the rule was no senior creditor, meaning senior bondholder or depositor in a Eurozone sovereign bank could suffer a loss. They seem to have overcome that inhibition. And I'm not sure I would use the word template, but it certainly has put into play an element that has not, in the Eurozone crisis to date, been in play.
Does the set of policy moves that Europe has just gone through move the EU closer to a cohesive fiscal union, in your view?
Well, what it will do, I think, is put great pressure on the need to come up with a Eurozone-wide deposit insurance framework. You recall last year they decided that they would have a unified, harmonized bank supervision.
Right, we were talking about this in June of 2012,
Indeed.
where you predicted that Cyprus was going to end up in trouble.
Yeah, indeed. And the Germans and others have quite sensibly said you can't have a unified deposit insurance framework until you have unified bank supervision. So they're on the path to that, but this will surely show that they need to accelerate that process and find some way of being able to say to depositors, no matter where you are in the Eurozone, you're as protected as you would be anywhere else. Otherwise, you'll have this flight out of the perceived weaker banks and the perceived weaker countries.
Do you think the EU is going to survive this crisis?
Yes, I do. I think this has been a blow to them. There's no doubt about that. None of the prior bailouts have been pretty. but this one is particularly grisly.
No, I don't suppose it's ever a happy moment when you need to bail out a sovereign nation. Lee, last time you were on the show, you said Cyprus was the next EU trouble spot. Looking at the map today, who's next?
People say probably Slovenia, but remember, we have Spain and Italy that have been in the crosshairs now for
and
quite
Italy
some
still
time.
doesn't have a government.
Now, Italy has a political issue as well. Spain arguably has a political issue. So it's those two are not out of danger.
All right, forward we go. Lee, I hope next time this flashes up, you'll come in and talk to us.
Will do. Thanks.
It's Lee Buchheit from Cleary Gottlieb. If you'd like to learn more about the cases and issues we just discussed, be sure to go check out our offerings on BloombergLaw.com and also on the Bloomberg Terminal. You can see more of our videos on YouTube, and you can follow our updates on Twitter. I'm Lee Pacchia. Thanks for watching.